down some 5 to 6%. The KBW Banks Index now down close to 40% from its January highs. Wilfred Frost, CNBC Business News, Washington.
So, whilst we had Wilfred's excellent package, I've been very naughty. I went to our guest host and I said, you've got to invest in a bank. He's like, I have to invest in a bank?
Yes.
I have to? I said, oh, you've got to invest in a bank. Daniel, give me a name. So he did. He gave me Bank Inter, which is a Spanish bank. So and look, the producers, they're brilliant.
Of course.
28% down over the last 12 months. To be fair, most of it's in the last month or so. But here's my point. This bank trades on 8 times forward, so around about half of the S&P when it was trading at its median. So it's significantly discounted. And when I'll bear in mind what you said about value traps. And it trades at a price to book of 0.83. So that's quite solid compared with a lot in the sector as well. But I'm making you buy this bank. Yeah. Why would you buy this bank? Well, why also were you so reticent about buying any bank?
Well, I continue to be reticent about buying any bank because banks are being told all over the world to do things that are impossible to put together for an equity investor, which is on one side they need to strengthen their balance sheet, on the other side they need to lend more at lower rates.
That was 2 days ago. Yesterday they were told you don't have to strengthen your balance sheet.
Okay, even worse.
The counter-cyclical buffers were in December 2020 in the United Kingdom were going to go up to 2% from the current 1%. They just scrapped all that and put it down to 0%, which released £190 billion yesterday for the British banks alone.
But when you have such low levels of return on tangible equity, massive risks of rising non-performing loans, and at the same time you have an entire board and management team that is based and fully committed to improving the balance sheet at any cost.
I hear what you're saying, but will you admit you were wrong about the regulatory capital side of things?
No. They will change it a little bit, but it's not going to be even
it's just
enough.
Gone from 1 to 2 to 0. That's
here in the UK.
That's coordinated.
That's here in the UK.
You don't think that's going to be replicated?
You're going to see that in the Eurozone? I find it very hard to believe. Very, very hard to believe.
I need to get you in here tomorrow because I want to see you eating a great big hat.
Absolutely, no. But let me tell you why. And let me tell you why. The moral hazard of the entire Eurozone spectrum, of course, is concerned about the moral hazard going back to banks. So the ECB actions are going to be hindered by the impossibility of taking massive actions that are perceived by the population as helping the banks, which is not the case. I don't think it's very easy from that perspective.
I mean, the irony here is that we've sat here and we have looked at the Chinese model and we've said, isn't it disgraceful? Isn't it awful? Look, they've got this state-directed lending policy.
Yeah.
We've now got a state-directed lending policy. We've just told the banks that they have to maintain lending to entities that may be on their last legs or maybe zombies from the last time round.
Yeah.
So effectively, we've now gone down the road of replicating China's version of capitalism for understandable reasons. But what we've also done is we've confirmed that the bank's sources of income are going to be even more impaired going forward. So their NIMs are going to get worse.
Absolutely.
Because interest rates have come down. Their fee income and their wealth management businesses are going to shrink because assets under management are going to shrink because people don't put them into risk assets anymore. And when it comes to the possibility to make trading income from the volatile markets, well, we dealt with that last time round because we told them they couldn't trade on their own behalf here.
Yeah.
So what do the banks become after this?
Japan banks. That's what they will become. That's exactly what Japan did after the real estate bubble burst and zombified the banking system and zombified the economy with it at the same time. And it did exactly that. It spent $6 trillion on infrastructure projects, at the same time maintained lending to everything that existed already, but created a credit crunch on all of those businesses that required working capital money for the future. So what ends up happening is you zombify the economy. But we're going to see that.
There are lots of moments in history to compare. If you look at some of the banks, and Deutsche Bank was an obvious go-to, given all the issues that we've reported on in recent years, from Coco's paying out dividends to whether this should be consolidated, drop in earnings, fines, the list goes on. So there's plenty down points to really rake over. The one that compares, if you look at the sharpness of the reversal, is right back at the start of 2016. when we had market volatility, and just coordinated that with what the ECB did at the time. It was Mario Draghi when we were at minus 0.3 on the deposit rate. He didn't move. There are market expectations that he would cut, but he didn't. He stood back and didn't think it was the right thing. Is there a message today for the ECB that when you are in such deep negative territory, that you might do more harm than good to some of these banks? And maybe, just maybe, Christine Lagarde should step back.
Well, there is a message, definitely, that it was a completely, absolutely crazy idea to cut rates and increase and maintain the quantitative easing program in a growth period, because now they've run out of the tools that could help in a financial downturn. However, I don't think that the main area of concern for the ECB right now is what is going to happen to banks. They have created some form of offset to the negative rate territory. I think that the problem for the ECB is that on one side, it is aiming to support the European Commission in its Green Deal policy, and at the same time,
I'm loving disagreeing with you today.
Please do.
This is so much
Please
fun.
do.
We've got crisis all around us, and I'm loving the debate. That's just not true that the ECB isn't concerned about what happens to the banks. They are totally concerned. But you know why they're totally concerned?
Yeah.
Because I was going to start swearing as lies in the pub or something. They completely and utterly, as a European project, not the ECB, have mucked up CMU.
Yeah.
So there is no capital markets union. It's like you look at where the capital markets union office is, and there's a big dust bowl going through and tumbleweed and things. So the only major transmission mechanism that Europe has of getting money from A to B, i.e. from where it's hoarded to the customers, if indeed there's ever demand back again, and indeed keeping those businesses going, is through the transmission mechanism of the banks. So I would disagree with you heartily, but in good spirit.
Of course.
That the ECB does care about the banks, not because they have some love of the banks themselves, but because that is the only transmission mechanism that Europe's got.
Let's see where we agree. Okay, we're meeting in the middle. The ECB cares a lot about banks lending. They don't care about banks' profitability. Never have.
I agree entirely.
There you go. That's what I was saying.
You can't have the lending without the profitability unless you've got stupid state support for too many banks in Europe. Oh, yes, we have.
Well, by the way, let's start from the beginning. The reason why banks in the Eurozone are so weak is precisely because they lobbied so aggressively for a massive QE and cutting rates. And now they should have been careful with what they wished for. But more importantly, the problem in the Eurozone transmission mechanism of credit is not from the ECB to the customer, you've said it, that there is no real demand for that kind of credit that the ECB believes that is needed. Because it's not a problem of demand, it's a problem of supply.
And then we come back to disagreeing, because there is demand, and maybe not the end consumer trying to buy their new whatever it may well be. I was thinking of various products. I keep coming back to toilet rolls. But it's not, it's the businesses and small and medium-sized businesses desperately need that credit because they're not getting liquidity from that end customer. So they need that life support to keep them going through this very tight bit.
But that's for working.
That is demand. That is real demand.
That is for working capital, and it's nowhere close to 20 billion euros a month. Nowhere close. Yes, there is. But put together all the working capital and investment requirements of SMEs in the Eurozone, put them together, multiply it by 2 if you want, you don't get to the level of money supply growth that the ECB is implementing in the economy. The problem of the ECB is that it thinks that the reason why credit growth is not as much as they would have liked is because there's a problem in the transmission mechanism, not because there's simply not enough demand in the market. And again, the reason is because the ECB has not addressed the non-performing loan and the overcapacity problem in the Eurozone.
Loving your work, Mr. Lacalle. Luckily, we get another hour and a half of it in this show. Okay.